Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, February 4th, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you again today. Looking at futures, not really a whole lot's changed. It looked like last night we got a couple pretty good earnings reports, especially out of Palantir. PLTR, one of the leaders in the software space, came out really, really good numbers. In fact, I got it right here. They were expected to only come in with 11-cent profit. They came in 14 cents. So certainly ahead of schedule there. And their revenues were expected to come in at $777 million. And they were at $827 million. So 50 million beat in the revenues, and also beat by about 25% on its bottom line. And the stock up. Let's see where we are right now on Palantir. It closed yesterday around 83, I believe. And it's up almost $20 today at 103.22. So Palantir up 23%. So that's certainly going to give the software group maybe a little bit of a lift. But as I was saying last night when the report came out, we had a pretty good move in futures. The QQQ was up close to 1 percentage point. I saw that the IWM, which tracks the small cap Russell 2000, was up about 1%. This morning, it's kind of all faded. We got right now the diamonds, which track the Dow Jones, down about 0.2%. Spider down just slightly, just fractional, down 14 cents on the Spider, down to 597.63. So just negligible to the downside. We got the QQQ, though, that was up almost full percentage point after the bell yesterday when some of these earnings came out, and now up 0.14%. So kind of giving it all back. I didn't see the IWM down 8 cents from 223.83 to 223.75. So really not a whole lot in terms of change in the futures. And that's a problem on the IWM. We'll take a look at that chart in just a little bit, but the 225 area has been a pivot level where we've seen resistance at the 225 level. We've seen support, and we keep flip-flopping above and below it. And currently we're below it. So it's really hard for the market to do a whole lot, small caps anyway, until we at least get back through that 225 level. So that's step one. But all of the major indices are kind of like that. They're off of the recent highs. We're seeing rotation into some more defensive areas and away from some of the aggressive areas. Technology in particular needs a lift. It's down near a 52-week relative low versus the S&P 500. And so if you're wondering why we seem to be stuck near about this 6,000 level on the S&P, where we've kind of gone up above, below, and then we go back up above, and then we're below. Really, last few months, we've struggled to tack on anything. It's not because there haven't been pockets of strength in the market, but the pockets have been the wrong pockets. Technology has not been strong. It's been weak, and that's 32.5% of the S&P 500. So until we get that group going, chances are we're going to struggle. And when you look at technology, one of the first things you think about is semiconductors, and semiconductors not really doing well. So anyway, let's take a look at what happened in the action yesterday, and we'll go from there. So the Dow Jones Industrial Average yesterday down about 0.25 point. These numbers, we came back quite a bit from where we were at the opening bell. We had a pretty big gap down at the open. So some of these numbers improved a lot throughout the day. S&P 500 down 0.75%. NASDAQ down a little bit more than 0.8%. The NASDAQ overnight futures were down almost 3%. I don't know exactly where we opened. I think we opened down maybe 2%, or so. I don't remember exactly where we opened yesterday. But my point here is we worked our way back. So the market did show some resilience. We did come back from lows, but you just wonder with these gap downs and with these different stories that are worrying the market, and with the volatility index rising, how many times are we going to go down and come back until one of these times we just kind of, the brakes fail us and we just keep falling? I don't know. But it is one thing I'm watching pretty closely. Russell 2000 down more than 1%. You can see 223.83. That's what I was talking about. 225 has been that key pivot area. I would say the whole 225 to 227 area. And I've had folks ask me, well, are you changing your bullish call on small caps this year? I don't know that I'm changing it, but I was certainly recognizing that the market environment that we're in right now, where we've got the Fed concentrating again on inflation, not suggesting that we're going to cut rates. I think we're going to cut rates later this year, but that's not the environment. That's not what we're feeling. That's not what the Fed's saying. And I think quite honestly, I think I think Wall Street is just a bit confused. I don't think Wall Street knows exactly what to do, which is why we're seeing all of this back and forth and all of this hesitation, like with the S&P 500 around the 6,000 level. So we'll see how this plays out. But yeah, right now I'm a little worried in the short term about the Russell. I'm also worried about the NASDAQ and the S&P 500. Been talking about it. We had a great event last night. We got another one coming up tonight, and that's for all of our annual members. So this event is going to be a little bit more detailed and focused. Yesterday, we talked on top of the surface about some of the signals that, I feel we need to be thinking about, that we need to be aware of, because I think it could lead to some selling, perhaps even a correction, a 10% correction. And so, we want to keep an eye on these different topics. But tonight, we're going to deep dive into it. And I'm actually going to talk a little bit about targets, where I think the S&P 500 could go if the volatility picks up and this selling accelerates to the downside, we start losing support levels, things could really start to pick up steam. Again, I just see a lot of warning signs out there, but still it all comes down to price action. No matter how many secondary signals are providing warning signals, until we see a breakdown on the chart, which for me, when all the major indices move down below their 20-day moving average, that would be a little bit more problematic. And we've been testing it. We've been struggling with it, but so far we've been holding it on most of the indices. So anyway, we'll look at those charts in just a minute. Mid caps down 1.25%, and there are your transports. Once again, I'd watch that 15,750 level. That's been a key support area to watch. We were down 2.3% yesterday, 15,927. That means we're within almost maybe just a tad over 1% of getting down to that 15,750 level. Don't want to lose that. That would be another, feather in the bear's cap. Moving on to the sectors yesterday, energy, utilities, staples, healthcare, all leading. So, yeah, we started low, yesterday, and then we started battling back, but none of our key areas made it back into the top half other than communication services. So communication services continues to be one of our best groups, especially among the aggressive areas. But look at the bottom of the leaderboard. Technology, consumer discretionary, industrials, financials, they all were down. And the reason why the market didn't come all the way back and move into positive territory, you're looking at it right there at the bottom two groups. Technology, 32.5% of the S&P 500. Discretionary, not sure exactly how much, but I want to say maybe 10%, something like that. So you're talking about more than 40%, 42% of the S&P 500 is made up of consumer discretionary and technology names. And there's probably another 8-10% in industrials. So these bottom three right here, those three in industrials are down about 1%. Those three are over 50% of the S&P 500. It's going to be hard for the S&P to go up when 3 of the 11 groups, which represent over 50% of the index itself, is going down. That's a problem. That's been a theme of late. I mean, technology isn't just now going down, here recently. I'm going to let's take a look at this chart right now. Here's XLK, and you can see, you're like, well, wait a minute, it's trending up, right? I'm talking about on a relative basis. So if you're looking at technology relative to the S&P, and by the way, we're teetering here near some support right around 225 on technology. That number sounds familiar because that's the IWM support level too that we just lost. But here's this 225 area. Go a little bit lower, got down to 222 or so, and then over here 220. I mean, this is an area of support, and if that all breaks, and technology is 32% of the S&P 500, that's not going to have a good look on the S&P. But what I really wanted to show you was take a look at XLP relative to the SPX. And let's go down here. And don't need the volume, but I really wanted to change, let's see, change the candlesticks, go to a solid line, go out a couple years here, see what that looks like. So here's technology relative to the S&P 500. Now, when we, moved back in July and we were up basically near a top June, July timeframe, technology was leading the S&P 500. But since then, the S&P 500 is trying to go higher, but it's doing so with a big, heavy load on its shoulder. And that's called technology, because technology is just weighing down the S&P 500. So the fact that the S&P can continue to battle with all-time highs while the technology group is doing this, I mean, that shows a lot of resiliency on the part of this secular bull market. Money is rotating, which is a hallmark, but it needs to rotate back. We do not need to see technology moving to a 1.5 year relative low, and that we're getting pretty close to it at this point. So we need something, and we need a catalyst to get these technology names rolling. I'm not quite sure what's going to do it here in the near term. Many of the biggest technology names have already reported earnings. Like I said earlier, Palantir comes out with a great report. Stock's gapping up nicely, but let's see what, it's not having a huge impact on the QQQ. Let's see what happens after the bell rings and the market opens today. Let's see if we can get some more love into this technology group. If we don't, I think that's just adding to some of the bearishness. Bearishness maybe isn't the right word just yet. To me, it's cautiousness. Risks are building. I think bearishness comes when you start seeing breakdowns that confirm all of the cautious signals. So I just feel like we're right there. I think the market's teetering. 10-year treasury yield. Talk a little bit about that. So right now we got 10-year treasury yield today up, and it is up about 5 basis points. Keep in mind that some of the areas of the market normally that benefit from these lower rates, we've seen the 10-year treasury yield move from over 480 back down into the 440s, and something like the small caps, which generally move up nicely when we start seeing, interest rates fall. Part of the problem here is, you can see the IWM falling back down. Part of the problem here is that the IWM is much more focused on the Fed funds rate coming down, not so much the 10-year treasury yield. The 10-year treasury yield is the long end of the yield curve. The Fed funds rate is the short end. And the short end is what banks use to borrow from one another. So when those rates come down, it makes it much, much easier for banks to get capital to lend out at higher long-term rates. So it's best for small caps. I mean, the 10-year treasury yield, again, isn't the problem. It can stay in the 4s. What the banks need and what our economy needs is for the short-term Fed funds rates to come down. And, you're talking about, a lot of folks say, well, rates don't need to come back down because we don't need easy money anymore. Yes, we do. Not easy money, but what the Fed does is the Fed is trying to maximize employment. That's one of their key goals. They got to maximize employment, and they also need to stabilize prices. So basically, they want to make sure they're trying to keep the economy strong, but they don't want the economy to be so strong that prices are no longer stable and we start seeing inflation pick up. So it's a balancing act. They only got 2 mandates. Those are the 2, but it's kind of, you got to massage them both simultaneously. And so that's what the Fed is trying to deal with. But for those that say, oh, the easy money era is over, we need to stop it, I would argue, because I think you've got an economy that's being led by a lot of big companies. The small companies across this country are not in great shape. And the way they get in great shape is to have better access to capital. A lot of that capital has gone to the big money, not to the smaller folks. And so I would disagree with folks who say we don't need cheap money. We don't need cheaper money. Most of this country does need cheaper money. to get the economy going. Once the economy's going, payrolls pick back up again. We see the unemployment rate drop back down. Not that it's crazy high, it's just that it's been trickling higher. Get that back down just a little bit. I think the economy could hum better. And I think that that would make for a much better market environment. Unfortunately, that's not what we have right now. And we've got the Fed, playing, I don't know, whatever you want to call it. I call it waffling. You can disagree with me. I don't care. That's your opinion. You have a right to your opinion, just like I have a right to mine. But I believe I think the Fed over the last few years has been causing a lot more drama than they need to in Wall Street. I think they have triggered some pretty big market slides because of the waffling, because of the lack of conviction, because of the uncertainty they are creating or helping to create. But anyway, I'll be done with that. I think everybody probably by now knows how I feel about the Fed. And by the way, I don't. Someone said, "Well, you act like you're smarter than the Fed." No, I don't. I'm not. The folks on the Fed are brilliant. They're brilliant people. I've never once said that they're dumb or they're not smart. I just don't think they're making the right choices. Comes down to, your own opinion. That's all. And I think my opinion gets backed up with what's going on in the market and the back and forth and the rotation that I see. I think a lot of it has to do with the uncertainty over the economy and over what the Fed's going to do next. All right. Anyway, IWM got to get back through this 225 area. So here, see the top? I mean, I can annotate this real quick. Probably most of you have seen this. But if I draw this line, there's the 227 level. Here's the 225 level. So on the way up, you can see this zone is where we really struggled. And then with the election, we saw the big gap up on the IWM and in the markets in general. Went up, we came back down, we tested this area, went back up again, posted that shooting star candle, which is a reversing candle off of an uptrend. And we sure enough reversed, came back down, failed to hold this support level, tested it 2 more times, coming back up, couldn't get through. And then just recently we got up, we couldn't get through the moving averages, and we've been squeezing between 225 and 230, which is exactly where the 20-day and the 50-day were residing. So we were squeezing until yesterday when we gapped down and we actually finished below this 225, 227 level. And that's why I'm watching it so closely, because it is an area that I think will benefit if rates are lowered. We saw that back when rates have been lowered or when they were talking about being lowered. You can see IWM was in a tremendous uptrend. And unlike the last 3 years, during this period, the IWM actually had outperformed the QQQ and the SPY. So you could see the rotation going into small caps. But then we got the reversal again from the Fed. And as a result, I think that's why we're seeing this delay again in small caps and why they're not performing well. I think when the Fed starts getting back on board with rate cuts, I think you'll see this change. All right, let's pull up the S&P. So here's the S&P. We've had a couple hollow candles down here just below 6,000. And you can see a couple months ago, we were around this 6,100 level. Go all the way back to November, we were at 6,000. We closed yesterday 59.94. So over these last 3 months, I mean, we've been trying to get moving to the upside, but we've been failing. And again, part of that reason is that this relative weakness in technology. Look at where we've gone just since the end of December. And this is where we were as we started November. And look at where we are now. 32% of the S&P 500 is not performing as well as the S&P 500. That's going to take a toll. And that's unfortunately where we are right now. NASDAQ 100, of course, this is home to a lot more aggressive areas of the market. We're seeing the gap downs, but we're seeing so far action hold. I think the areas I would watch very closely here are to the upside, a little above 22,000. That's clear resistance. That was the all-time high back in mid-December. To the downside, we got the recent low at 20,600 or so. But I actually think it's the gap up from the election. I think that's going to be the key area. I think around that 20,250 area. So I think we could go down almost 10%, probably about 8% on the NASDAQ and get down to that level. And I think that's the key level for me anyway, on the NASDAQ. I think if we can continue to hold that gap support from the election, then I think the market's in pretty good shape. If it doesn't, however, then we got more problems. And so we're heading into a period of time. Once we get past the next couple of weeks of earnings, we're going to be heading into a time where the market does have a tendency to struggle a little bit. And so if we haven't made a breakout by then, we may simply run out of gas. Small caps, already talked about that. I do want to talk about earnings beats just for a minute because we did have a big event last night. It was a free event, by the way. You can go on YouTube and search for it. But it was just, it was a live stream that we did on YouTube. Had a huge crowd, great viewership after the event as well. So going over to YouTube, you can search for, just search for earnings beats or throw my name in there, Tom Bowley, and look for the event we did yesterday and watch it. I talked about a lot of warning signs in the market right now. I'm really passionate about that. I think, I'm not bearish. It's kind of a fine line. I believe we're still in part of a secular bull market. I think a year from now, I'm not going to be worried about what I'm worried about right now. So I think this is a short-term kind of a problem where I think the market could sell off. We just need to be prepared in case it happens. But once we get past this period, once we get through the next, couple months, I think we'll see a different market. But right now, I think the market is ripe for some issues. And anyway, check that video out. And if you want, after the video, we talked about tonight, we're going to do another event at Earnings Beats. This is not going to be live streamed. It's not going to be on YouTube. Instead, it's going to be just for our annual members at Earnings Beats to go in more in depth regarding some of the issues. I want to talk a lot about what's led to prior corrections. I'm going to spend a lot of time on that. And talk a little bit about some of the technical signals that precede corrections, 10% corrections in the market, and address those technical issues. Where do we stand? Are they pointing to a correction? So some pretty key stuff that if the market drops 10%, I don't know, think about what you have in the market. If you could save 10% to the downside, it'd probably be pretty meaningful for most folks, especially if you've been working all your life and you got big amounts in the S&P 500 or in the NASDAQ or in some mutual funds, ETFs, whatever. If the market drops 10%, being in cash and saving some of that might make sense. Anyhow, you got to check this out tonight. But while we're doing this, we have a flash sale. So I know a lot of folks that follow us here on YouTube, follow me and my articles over at Stock Charts, are not in a position to pay us what we charge for our service. We try to give back to the community as much as we can. And because of what we see potentially happening over the next month or so, we're running a flash sale. So we'll take $200 off of our annual membership. Our annual membership normally runs $997. That brings it down to $797. If you're a monthly member at Earnings Beats, you pay $147. Over 12 months, that's $1,700 some dollars. Instead of $1,700 and some monthly for 12 months, just come on board for $797. Save $1,000. Anyway, obviously we have to get paid for our services, but check it out. If you're leery, one other thing you could do, if you scroll down, actually, you can take out a free, scroll up. You can take out a free 30-day trial and just see what our service is about over the next 24 hours or so. And if you like it, take advantage of the flash sale. By starting that no-cost trial, you'll get the rest of your 30 days. And then the flash sale will just add on 12 months to the end of it. So you'll effectively get 13 months for the flash sale price. So anyhow, it's a great deal. I just wanted to point it out because I know a lot of you do talk about, hey, it's just a little pricey. I can't afford it. We're trying to make it, affordable as best we can. All right. The other thing you can do if you just want to kind of get to know us at Earnings Beats is you can sign up for this free newsletter that we have. Comes out twice a week. I usually give a chart, couple paragraphs, and it's just about some of the things that are important to us at Earnings Beats. Now, if you go over to this chart I'm going to show you, this is kind of something that I might talk about in a newsletter. Booking, I'm just going to show you, it's pulled back quite a bit. And you can see that there's the top of gap support. Here's the bottom of gap support. And we're kind of coming down, testing this area of support. This is a really big area of support for Booking. I mean, maybe we get another $200 to the downside from 4,600 to 4,400. That's if we were to go to the bottom of the gap. I think entering in this area, in this zone, makes a lot of sense for this stock. Even though I'm not overly bullish the market, I still think there'll be individual stocks that will do well, that will bounce off support. I don't think the entire market's just going to drop 10% if the market does at all. You'll still have leaders. And Booking is interesting because it is at these key support levels, this key gap support level. And I want to show you Booking on a seasonality chart. This goes back 20 years. Look at the 3 best months of the year for Booking Holdings. It goes up 75% of February's over the last 20 years. So basically it goes up 15 out of 20 years. March, I guess that's going to be 14 out of 19. There must be maybe 20 years ago. I don't know. Or no, we haven't had March this year. That's why. Duh. We have started February, but we haven't started March. So this would be 14 out of the last 19. But if we go up this March, it would be 15 out of 20. Here, this is 15 out of 19 Aprils that Booking has gone higher. So look at those percentages, the 3 best months of the year in terms of the chance that Booking is going to go higher. The top 3 months of the year are back to back to back. February, March, April. Look at the average returns. Let me zero in here so you can see this. Look at the average returns on Booking for February, March, and April. Add those across. 10.4, 14.5. That's the average return from February 1st to April 30th over the last 20 years on Booking. Now, that doesn't guarantee us we're going up. But I think it's pretty clear we can at least make a statement that this company loves these next 3 months, historically. Will it happen again? I don't know. But it's interesting that we've got Booking going down to key gap support just as we're kicking off this 3-month period. So, I think charts like this, reasoning like this, doesn't mean you're going to make money, but I think you're putting yourself in a better position to make money. Again, there's no guarantees ever. But if you got a stock that's reaching a key support and you've got seasonality lining up for the next 3 months, that is at least something. One of the stocks that's on our seasonality list, chart list.
Hey, Tom.
Beginning of the month. Yeah.
You dropped off there for about a minute. Sorry, I didn't mean to cut you off. I thought you finished your point, but you cut off there for about a minute. So you might want to rewind a little bit about what you were saying.
Was I just talking about the seasonality in the chart?
Yeah, I mean, for the last minute there, you started and then you cut off. It looked like your internet may have went out there for a minute or so.
Okay.
But
yeah, I'm just going to say, this is a couple areas of key support on Booking. This was a gap up from back at the end of October with its last earnings report. The stock ran up really nicely. Actually, if I come out of here, I can even show you that over, if you look at the AD line, even though prices have come down, the AD line remains strong. Relative strength right up through the middle of December in this peer, among its peers. And ever since it topped in mid-December and we've come back down, you're going to have pullbacks from time to time. And when you do, you're probably going to show a little bit of lack of leadership while you're pulling back, consolidating. I look for this to turn back to the upside. And what I found interesting, because I also like Expedia, but I was looking at Booking versus Expedia. And when I look at this chart, it looks like Booking is underperforming, which it is over the course of the last maybe 8 months. But I'm going to go out just a little bit further. Let's do a line chart. I think that gets rid of a lot of the noise. And then let's go back here and do the last 5 years. And this tells a little different story, because over the last 5 years, Booking has been a much better play than Expedia. But you can see that over the last 8 months, 7-8 months, we have had this pullback. So I don't know. We'll see where we go, but I like Booking. I like Expedia as well. And if we pull up the seasonality, excuse me, on the entire group, which is travel and tourism, and we go back 20 years, you can see this isn't just a bookings thing. Travel and tourism likes these months heading into spring. And it kind of makes sense because the stock market looks ahead and most people start planning trips for the spring and the summer. So starting in February, it would make sense for these companies to come under, be under that kind of umbrella where everyone wants to buy. So anyway, it kind of makes sense. And when I find seasonality, I always like to think about it. It's like, why would this company do well during this period of time? Or why would this company do well in the first month of all calendar quarters? Or, whatever. And I think there's reason for travel and tourism to do well as we start moving through winter and start thinking about spring and summer. So anyway, just wanted to point this out. The entire travel and tourism group, February to April, goes up over 10%, 10.3%. So it just so happens that Booking at 14.5% outperforms its overall, group, its peers. But this is a group that likes this time of the year. And you go through the rest of the year and you got, July, August, which that pan out pretty well. November is a good month, but by far, this is the most concentrated period of strength. So I just wanted to point that out. Now we're getting ready to, actually we did just open a couple minutes ago in the market. So I'm going to wrap up. I did want to show you Palantir though. Let's take a look at, get an updates. There's your gap up to 102. We're sitting up right now. $18 on the stock, 22%. Spotify, another big winner. You can see gapping up. It's up about 7 2/3%. And I wanted to also take a look at this morning's earnings just to see what earnings came out. Merck actually came out and beat, but I saw they were down pre-market. And so Merck way down. Stock is breaking down. Watch the volume on this candle and watch. I've been saying I thought Merck could go down to about 90. Looking at what I was looking on the chart, if we look at a long-term monthly chart, let me pull this up because I actually like, this is the breakout right here on Merck when we're in that uptrend here, but we broke out above this 90 level and you see these tails coming back to 90. And now that's right where we are right now at 90. This is we haven't gone below the 50-month moving average since all the way back in 2018, late 2017, early 2018. So from a long-term perspective, this has been a great time to enter Merck. And we're gapping down. So on the daily chart, one thing that I would watch for here is let's see what this candle turns out to be today. Is it some sort of reversing candle? Is it an exhaustion candle? In other words, off of this downtrend, we get this massive gap down. Everybody says, that's it, I can't take anymore. They throw the stock out. They sell it, but then market makers accumulate and we get some sort of a big reversing candle on heavy volume. I mean, if the volume today were to pick up and we see we've already got 6 million shares traded in the first 4 minutes of the day. So it's not going to keep up that pace. But this is, a day where maybe we get one of the heaviest volume days of the year. And if it's a reversing candle, it could be an exhaustion kind of a day. But this is for long-term value, folks. This is not for momentum traders. Obviously, it's gapping down. It's breaking down. It's not a momentum trade on the long side. It's more of a value trade. So if you're not a value investor, skip it. Let's see if there was anything else reporting. Pepsi reported. 195 versus, or excuse me, $1.96 versus 195. So they did beat slightly. Stock is down a little bit. Later today, we're going to get AMD. Of course, we're going to get Google after the bell today. That's going to be a huge one for the NASDAQ and for the S&P 500. Then we're going to get Advanced Micro Devices, big semiconductor company. That's certainly going to influence the NASDAQ as well. Amgen, so big biotech company, reports after the bell today. Chipotle, haven't looked at Chipotle in a while. Let's see what Chipotle looks like. Chipotle just kind of, I don't know, sideways consolidating. TDG, TransDigm, this has been a company that's done extremely well over a long period of time. They reported $7.83 versus $7.48. That was their earnings. So they had an earnings beat. Stock was down this morning. It's already made its way back up, almost back to the even level. But look at this stock long term. This has been a great performer. Very steady performer going up for a long, long time. And yet a lot of folks don't know about it, never heard of it. TransDigm's great company. Anyway, that's it. Let's see what the market's doing overall. We got the Dow down, S&P up, NASDAQ up about 1/3 of 1%. A little bit of move up in the S&P 600 small cap. Let's see if the IWM is getting close to the 225 level. Now IWM actually is only up 2 cents. So anyway, be careful out there. That's my message right now. I do think, we've got some second tier earnings, well, and still some first tier earnings. Like I said, Google's coming out today. We're going to get Amazon later this week. So we do have some of the big Mag 7 stocks that we need to be watching because they'll have a big impact on the market. But then we have those second tier companies, kind of like Palantir, that are reporting and starting to come out with some pretty big reports. Spotify this morning. So I think the market still got that chance to maybe try to make a push here over the next week or two. But I think we go into the second half, the back half of this first quarter. I think, we could run into some problems, if not sooner. One other thing I'll mention, volatility index. Watch the VIX. We had gone up through 20. We've gone up through 20 3 times already to start this year. So the market's already nervous. And if we, get one of these candles, or let's say a few of these candles, that could send the market spiraling lower. So I just wanted to let you know we're in that 17 to 20 range where I get nervous. Market's still okay here. But if that VIX goes back up into the 20s and starts rising, that's when a lot of impulsive selling. Really very, very careful with the market. Anyhow, have a great day, everybody. I'll be back next Tuesday to give you a summary again. Of course, I got other videos on YouTube that come up throughout the week. I've got a video that I do for stock charts every week, comes out Wednesday. Well, I do the recording on Wednesday. Usually it comes out on Thursdays. I do my weekly recap here at Earnings Beats on the weekend. So Tyler will host that for me as well. We do a live trading room on Wednesdays every week. So if you wanted to try the service, hit that, go back to the screen there and start your no-cost trial. Over your no-cost trial over the next 30 days, you'll be in 5 live trading room sessions for the next 5 weeks. So not only do we talk about potential trades, but I also talk about just strategies of trading and using our information at Earnings Beats to try to come up with the best reward to risk trades and so forth. There's so much that we offer at Earnings Beats. Until you actually experience it, I don't think you can make a real good decision about the value of what we offer. But check us out, 30-day free trial. And if you just want to jump on board, we got our 48-hour flash sale, saving you $200. Anyway, have a great rest of your week, everybody. Happy trading.